Welcome to the Bulls, Bears, and the Bell podcast. It is Wednesday, August 5th, 2026. And if you are looking at a dashboard of the global economy this morning, I got to say, it looks like a picture of absolute serenity.
Yeah, it really does. I mean, Europe is hitting fresh all-time highs, the broader economy is humming along, and that inflation bogeyman that's haunted portfolios for years,
Yeah.
it finally seems to be retreating into the shadows.
Right, and this is but if you hold broad index funds right now, you are experiencing a massive multi-billion-dollar tug of war just beneath the surface.
So absolutely, because, while the rest of the world celebrates, some of the biggest, most hyped names in American tech and space exploration are waking up to a brutal bloodbath in the pre-market.
It's just wild. We need to cut through the noise of this morning's data dump and figure out exactly what is driving this massive rotation.
Well, it is one of the most starkly bifurcated morning sessions we have seen in a long time. You have total euphoria on one side of the Pacific, and then these ruthless, agonizing reevaluations happening on the other.
Yeah, and if you have been betting your portfolio purely on the idea that technology always goes up just because it is innovative, today is a glaring warning sign.
Yeah.
The fundamental rules of valuation are shifting beneath our feet.
They really are. So let's start with the immediate catalyst for all this global optimism, because overnight, a massive geopolitical narrative took hold.
Right, and it is entirely centered on the Strait of Hormuz. I mean, crude oil prices have just plummeted. We are looking at a sudden 5% drop, with Brent crude now hovering right around that $80 per barrel mark.
And we really cannot overstate the macroeconomic impact of a 5% drop in crude oil right before the U.S. markets open.
It's massive.
It is. The market is aggressively pricing in a major de-escalation in the Middle East. The trading desks are moving on rumors of a U.S.-Iran deal that would essentially guarantee the reopening of the Strait of Hormuz to full, unimpeded commercial traffic.
I am looking at this, and I'm trying to wrap my head around the sheer speed of their reaction. For months, it feels like the global market has been trapped in a giant pressure cooker, right?
Oh, totally. Everyone has been holding their breath over sticky inflation, terrified that energy costs were going to force central banks to keep interest rates punishingly high.
Exactly. And then this news drops, and suddenly it's a giant collective exhale.
Yeah.
But I have to push back on this just a bit. A rumor is just a rumor.
Fair point.
Are traders being completely reckless here?
Yeah.
I mean, pricing in an unconfirmed geopolitical whisper, this aggressively seems like a massive leap of faith.
It is a massive leap, for sure, but you have to look at how algorithmic trading and macro hedge funds actually operate. They do not trade on absolute certainty.
Right, they trade on probability shifts.
Exactly. If the probability of a blocked Strait of Hormuz goes from, say, 40% down to 10% overnight, the algorithms are going to instantly reprice the cost of global energy.
Wow, so it just cascades from there.
Yeah, and it is not just the price of a barrel of oil. It is the cost of maritime shipping insurance, which has been astronomical. It is the cost of diesel for the trucks moving goods across Europe.
So when those input costs drop, it changes the fundamental calculus for every central bank on the planet.
Because it gives them breathing room. If energy costs drop, headline inflation drops right along with it.
And that sends a flashing green light to equity buyers.
Bingo. It tells the market that the Federal Reserve and the European Central Bank won't be forced into a corner. They won't have to break the economy to kill inflation, because geopolitics is basically doing the heavy lifting for them.
And it seems like this sudden exhale in the energy markets is acting like a stabilizing agent for global currencies, too. We have been watching the U.S. dollar against the Japanese yen incredibly closely after the Bank of Japan's recent interventions.
Oh, the currency markets have been sweating.
Right, but this morning, that exchange rate is holding steady right near the 158 level.
Which is a huge relief for anyone managing global liquidity. I mean, when the Bank of Japan had to step in recently to stop the yen from collapsing, it sent shockwaves through the carry trade.
Because investors borrow cheap yen to buy high-yielding U.S. assets, often those big tech stocks.
Exactly. And when the yen is wildly volatile, those investors get margin calls and have to indiscriminately sell their U.S. equities. The fact that the dollar-yen is stabilizing at 158 today means that forced selling pressure is evaporating.
So the currency markets are digesting the lower energy prices without triggering a liquidity crisis.
Yeah.
That makes sense.
Right.
So if we take this Hormuz rally as our foundation, this sudden relief from energy-driven inflation, we are seeing a massive ripple effect across the Atlantic. It is setting up what looks like a textbook Goldilocks scenario abroad.
Yeah, the economy isn't running so hot that it triggers runaway inflation, but it isn't running so cold that we slip into a recession.
U.S. futures are reflecting this optimism right now. The Dow Jones futures are leading the way, up 0.46% to 54,333.60.
Strong numbers there.
And the S&P 500 is up 0.36% to 7,764.60. But Europe is where the real story is playing out this morning.
Europe is an absolute powerhouse today. They are hitting fresh all-time highs across the board.
It's crazy. The DAX in Germany just hit a record 26,268.90, up 0.3%.
But here is the mechanism I want to dig into because it's fascinating. The Euro Stoxx 50 is up 0.2%, and it is completely shrugging off a massive 4.4% tumble from Infineon.
And Infineon is a massive semiconductor player. They reported disappointing quarterly results, their stock tanks, and yet the broader European index still hits an all-time high.
And that right there is the textbook definition of a structural market rotation. For the last several years, if a major semiconductor company like Infineon dropped 4%, it would drag the entire index down with it.
Because tech was basically the only sector propping up the market.
Exactly. Today, capital is actively fleeing silicon and flowing directly into steel, industrials, and services. The underlying buying pressure in the traditional economy is so strong that it completely absorbs a massive tech sell-off.
And we have the macro data to back up exactly why that capital is moving. Overnight, Spain's services PMI printed a robust 58.3.
Which is huge, considering the consensus expectation was way down at 54.9.
So the Spanish service sector is absolutely booming. But let's be real here. I am struggling to see how a booming restaurant and tourism sector in Madrid offsets the panic we are about to discuss in the U.S. tech sector.
It sounds disconnected, I know.
I mean, how does people buying more tapas in Spain offer a safety net for a global equity investor?
It is a great question because on the surface, a restaurant in Madrid has absolutely nothing to do with a data center in Silicon Valley. But you have to view this through the lens of global asset allocation.
Okay, walk me through that.
If you are a trillion-dollar pension fund, you have to put your capital somewhere, right? For years, the narrative was that the global consumer was too fragile, just squeezed by inflation and high interest rates.
So you hid your money in big tech companies because they seemed immune to the broader economy. They were the designated safe havens.
Exactly. But a 58.3 PMI in Spain, which is a massive unexpected acceleration well above the 50-point expansion threshold, that proves that the European consumer is actually incredibly resilient.
And the UK FTSE 100 is up 0.2% today for the exact same reason, right? Their services sector just returned to growth.
Yes, and it tells those massive asset managers that the real economy is finally safe to invest in again. You do not need to hide in Apple or Microsoft anymore.
You could buy airlines, you can buy industrial manufacturers, you can buy financial institutions.
Exactly. That Spanish PMI is the ultimate proof of life for the everyday economy.
Which brings us directly to the massive paradox we teased at the top of the show. While the traditional economy is throwing a massive party, the NASDAQ 100 futures, the ultimate barometer for American innovation, are surprisingly flat.
It really is a tale of two tech sectors today.
Completely separated by the Pacific Ocean and defined by the relationship to physical, heavy infrastructure.
This is, without a doubt, the most critical shift we are seeing in the market this year. The narrative that dominated the software era is actively fracturing this morning.
Let's cross the Pacific and look at the Asian boom first. The Nikkei 225 in Japan jumped an astonishing 3.7% overnight, closing at 66,300.44.
And the Kospi in South Korea rallied 4.3%.
And the driver for this massive surge is what is being called physical artificial intelligence. It is the companies building the actual tangible hardware.
Right, the stuff you can actually touch.
Advantest, which does semiconductor testing, surged 8.8%. The memory chip giants, Samsung and SK Hynix, gained over 2%. Kioxia is up 4.2% because of sustained aggressive demand for high-end storage.
What you are seeing in Asia is the market finally waking up to the physical footprint of artificial intelligence. For the last 2 years, we have treated this technology like it is just magic.
Right, we type a prompt into a browser, and magic software living in the cloud gives us an answer.
But it is incredibly heavy. It requires massive data centers, specialized liquid cooling systems, and millions of incredibly complex memory chips.
Those Asian companies you just listed, they are the ones actually pouring the concrete and etching the silicon that this entire revolution sits on.
And when you contrast that physical reality with what is happening in the U.S. pre-market, it is a brutal wake-up call.
Let's look at SpaceX. They are down 7.5% this morning. And here's the context. SpaceX reported a massive 92% year-over-year revenue growth. They pulled in $7.8 billion.
A few years ago, 92% revenue growth would have sent the stock to the moon. Today, they are sliding.
Because the culprit is being labeled Capex anxiety, investors are suddenly terrified of the massive capital expenditures required to build out their Starshield infrastructure.
Wall Street is used to software companies where capital expenditure, or Capex, is pretty much negligible. If you build a software as a service platform, scaling from 1,000 users to 1 million users just means writing better code and renting a little more server space.
Your profit margins expand beautifully.
Exactly. But SpaceX is not a SaaS company. To build Starshield, which relies heavily on integration for military-grade, low-latency satellite communication, they cannot just write code. They have to physically build satellites.
They have to buy rockets, they have to build thousands of ground terminals, and all of that physical infrastructure burns cash at an astronomical rate.
Precisely. So when Wall Street looks at that $7.8 billion in revenue, they are no longer cheering the top-line growth. They are asking, wait, how much of that $7.8 billion are you immediately setting on fire to buy servers and rocket fuel?
Investors are demanding to know the return on investment. And SpaceX is not suffering in isolation here.
Not at all.
AMD is down 8.8% in early trading. They actually beat their second quarter earnings and revenue estimates, but they offered lukewarm guidance for the third quarter, and it triggered an immediate ruthless sell-off.
It is the ultimate proof that just having a good quarter is not enough anymore. AMD is a perfect example of how the hyperscalers, the massive companies like Google and Microsoft who buy these chips, are starting to scrutinize their own budgets.
If the hyperscalers slow down their purchases even slightly because their own capex is getting out of hand, AMD's forward guidance takes a direct hit.
And Wall Street has zero tolerance for that right now.
Which perfectly sets up this massive divergence. Because while AMD and SpaceX are getting hammered on capex fears, look at who is winning in Europe today.
Oh, Siemens Energy is a prime example.
They are surging 3.5%. They just reported record third quarter sales and a massive surging order backlog. I want to try an analogy here because it feels exactly like a gold rush.
Go for it. I love a good analogy.
So for the last few years, investors have been eagerly throwing billions of dollars at the prospectors. The software developers, the hyperscalers, companies like SpaceX and AMD who are spending all their cash trekking into the mountains, looking for the gold.
Right, looking for that killer app.
But suddenly, the market has realized how expensive the expedition actually is. So there is a massive vibe shift. Investors are dumping the prospectors, and they are aggressively rotating their capital into the companies selling the pickaxes, the shovels, the memory chips, and the literal power generators.
Companies like Siemens Energy, Advantest, and Kioxia.
Exactly.
Yeah.
Does that track with the mechanics of this rotation?
That analogy works beautifully, but with one massive caveat that listeners really need to understand. In this particular gold rush, the pickaxes cost billions of dollars to forge.
So Siemens Energy isn't selling a cheap wooden shovel.
No, they are selling grid-scale turbines and massive transformers required to power the gigawatt data centers that this new infrastructure demands. The scale is completely different.
It's massive.
Right. And Siemens Energy doesn't have to figure out how to monetize a consumer chatbot, which is incredibly difficult. They just have to sell the electrical infrastructure to the companies desperately trying to build the chatbots.
Their path to profit is clear, it is physical, and it is immediate.
Exactly. Investors are rewarding companies that have a tangible, immediate revenue stream attached to this infrastructure build-out, and they are punishing companies whose profits are years down the road.
It is a ruthless demand for long-term viability. Investors want to see the physical reality of the business model. And here is where it gets really interesting. Because this new demand for viability isn't just a tech phenomenon.
No, it's spreading everywhere.
It is spilling over into healthcare this morning, and it completely sets the stage for the crucial economic data we are waiting on.
The tolerance for pure hype is just evaporating across every single sector.
We are seeing this clearly with Novo Nordisk. They are down 3.5% in the European session right now. This is a company that has been an absolute darling of the market because of its blockbuster obesity drugs.
But European investors are starting to aggressively sell because they are fretting over Novo Nordisk's long-term competitive moat.
It is the exact same underlying anxiety we see with artificial intelligence.
For a long time, investors looked at Novo Nordisk's skyrocketing revenue and just assumed it would grow exponentially forever. But now, reality is setting in.
The market is looking at competitors catching up. They are modeling out potential pricing wars in 2027 and 2028, and they are asking, can you actually sustain these profit margins against the physical reality of a saturated market?
And this is a massive shift from speculation to strict valuation. Investors do not just want to see a great product today, they want to see the sustainable profit 10 years from now.
Exactly, which is why the macroeconomic data dropping later this morning is going to be so pivotal. The market is actively reevaluating risk, and it needs validation.
Let's give everyone the exact catalyst they need to watch on their screens today.
Perfect. So at 9 a.m. Eastern Time, we get the ISM Services PMI for July. The consensus expects expansion, but the key sub-indices you need to drill down into are business activity, employment, and crucially, prices paid.
And then at 10:30 a.m. Eastern Time, we get the EIA crude oil inventories, which are expected to reflect high summer travel demand.
That 9 a.m. ISM data drop is going to be the absolute crucible for everything we have discussed regarding this Goldilocks economy.
It really is.
Well, I want to challenge that narrative then. Let's play out the worst-case scenario. We have this entire pre-market riding high on the Hormuz rally, breathing a massive sigh of relief that oil is dropping and inflation might be beaten.
Okay, I see where you're going with this.
But what if that 9 a.m. ISM services data comes in too hot, specifically on the prices paid sub-index? If the Spanish services sector is booming, doesn't that imply U.S. services might be running hot too?
It's a very real possibility.
And if services are getting more expensive, does this entire pre-market optimism just evaporate?
That is the exact knife edge the market is walking right now. If we connect this back to the fundamental mechanics of inflation, we know that service sector inflation is incredibly sticky.
Because a local diner in Chicago is not pricing their hamburgers based on the daily spot price of Brent crude oil.
Right. They are pricing those burgers based on their rent, their insurance premiums, and what they have to pay their wait staff. So if the ISM prices paid index spikes at 9 a.m., it tells the Federal Reserve that inflation is deeply entrenched in the everyday U.S. economy, regardless of what is happening in the Middle East.
It shatters the illusion. So the 9 a.m. print is the ultimate stress test.
It really is. If the employment subindex holds steady, proving that Americans still have jobs and the economy isn't collapsing, but the prices paid subindex drops, it powerfully validates the morning's bullishness.
It proves to the Fed that they can actually cut interest rates without reigniting inflation.
And it's a big but if prices paid comes in hot, you are going to see a rapid, violent unwinding of this pre-market rally. Bond yields will instantly spike, and that capital flowing into industrials will head straight for the exits.
We are all going to be holding our breath at 8:59 a.m. So if you're managing a portfolio today, here are the key takeaways from this deep dive to keep in mind before the opening bell.
Geopolitics, specifically the rumors of a de-escalation in the Strait of Hormuz, are giving the broader global market a massive reprieve from energy inflation.
And because of that breathing room, we are seeing a historic rotation out of overpriced tech and into the broader traditional economy, driven by resilient consumer data out of Europe.
But beneath that surface optimism, Wall Street is enforcing a brutal reality check.
Investors are ruthlessly turning their backs on companies burning massive amounts of cash on software hype, and they are aggressively rotating into the companies building the heavy physical infrastructure.
They want the pickaxes, not the prospectors.
It is a remarkable structural transition from a digital fantasy into heavy physical reality. And that leads to a final thought I want you to mull over as you watch the market open today.
We know that this technological revolution is transitioning from ethereal lines of code into a massive physical footprint.
It requires unprecedented amounts of electricity, millions of acres of land, and oceans of water for cooling. So where will the next massive capital bottlenecks appear in the global supply chain?
If grid infrastructure companies like Siemens and memory chip makers like Kioxia are today's clear winners, what raw materials, what physical elements of the earth will the market be scrambling for tomorrow?
Are we about to see a run on copper, uranium, or rare earth metals.
That is the exact puzzle that every macro fund manager will be trying to solve over the next 6 months.
Keep your eyes glued to that 9 a.m. ISM data release. It is going to dictate the momentum for the rest of the week. Sincerely, thank you for listening to the Bulls, Bears, and the Bell podcast. Make sure to subscribe on Spotify or your favorite podcast app. We will see you next time.